kicked off here in a sec.
I think that was your cue, Barry. Hey, Sam Hantosh, good to see you, pal.
Bill, what's up, my man? Good to see you.
How cold is it in Michigan right now?
It's cold today. We just got our first snowfall, but nothing crazy. It didn't stick.
Well, that's good. Okay. Just get ready.
Yes, sir.
Looks like getting a few more people online. I'll go
good.
ahead and kick it off and get Bill introduced. Obviously, some of you know Bill very well, but Bill Bimel with First Lien. And, Bill and I have known each other for a number of years and have been very good friends. And I know during our last mastermind call, a lot of the questions that came up were around not just the residential space, but the commercial space. And I thought Bill would be an awesome speaker to have join us because Bill's got experience in both of those areas and can kind of, I know a lot of the questions from the resi people were kind of like, hey, what's it like to work on the commercial side? How do I make the connections? That type of stuff. So we have Bill with us today, and I think Bill is going to be able to, give some great guidance and help for everybody that's on the call. So that being said, didn't even introduce myself, but I probably know 98% of you very well anyway. But Barry Owens, CEO, founder for End to End Solutions. And we also have on the call Darren Cottrill, who's the CEO for our parent company, American Destiny. And you're all familiar with Darren as well. But with that being said, Bill, I'll go ahead and just throw it over to you. Darren, if you have anything, do you want to chime in on anything to start?
No, honestly, that was great. We, just due to the time constraints we have today, it's just because it's just throw it to Bill and let him run with it, and then we'll jump
wonderful.
back in.
I love that being put on the spot for something I've not even prepared for. It's just, it's wonderful. Thank you, Zoom user. It's really great.
Welcome. We like to do things this way. So, with that being said, Bill, like we talked about, it's an open forum, right? We'll get some questions from the people that are participating on the call. But why don't you go ahead and give just a little overview for yourself, the people who know you, and take it from there.
I mean, some of you know me, some of you don't. I started in real estate like all of you as a broker. My father, I used to ride around in the car listening to him talk about real estate as a child and never thought I would have any interest or ability or desire to be in the business. And then by fate in 2002, 22 years ago, I made my way back to South Florida for what I thought would be a summer vacation, visiting my parents. And my dad said, get into real estate. And for those of you who have read Malcolm Gladwell's The Outliers, one of his big premises is that some of the people when you get really good at something, it's because you've been kind of around it for 10,000 hours or more. And so I quickly when I got into real estate, I realized how natural it came for me because I had grown up listening to my dad talk about stuff. So I spent several years while I was interested in being a broker, and I'm still a Florida real estate broker today, 22 years later. I said to Dad, well, I want to practice what you preach. So we're going to start investing in real estate. And I started as a fix and flip investor. Then I got into doing some commercial deals. I got lucky buying, a couple of distressed commercial properties, and then found a mentor in South Florida who had been around the good old boys network of commercial real estate for his whole life, and spent about 5-6 years in the middle 2000s there doing tenant rep work for restaurants and retailers, Darden restaurants, like an Olive Garden, Seasons 52, Bahama Breeze, did some CVS deals. Everybody was doing CVS and Walgreens deals for a long time back then. Got involved with local developers and and then also quick service restaurants, McDonald's, et cetera. So I got my footing into commercial real estate in those middle 2000s. And I found out that the good old boys network is just kind of, it's a facade, right? And to this day, they continue to try to maintain the facade that CBRE or Kirkland and now, CBO, Richard Ellis, or, Newmark, or, if you're not with one of these big firms, Marcus and Millichap, that somehow you're not a real commercial real estate broker. And I realized that I particularly loved commercial real estate for a lot of the same reasons I also loved REO on the residential side, which was that it's a more corporate business. It's a business conversation. It's a lot easier to talk about cap rates. For me, I like cap rates and vacancy rates and our NOI and return on investment as a conversation. Much more exciting to me than what color the walls are and the kitchen cabinets. So I was doing that in the middle 2000s, and then boom, 2008 came along. The summer of 2008, I had a light bulb moment. I got a call from one of the founders of Condor Capital, who was bidding on one of their first big pools. This was 3 months before the fall of Lehman Brothers. And I had an opportunity to advise them on the purchase of 2,000 homes in Port St. Lucie. I think they paid 26% of UPB for that pool, which those deals were still around. Never know though. Never know. Someday. And then spent a couple years advising Condor, as most of you who have had contact with Condor, aka Gets It Solutions now. They also allowed people to start buying individual notes, and I bought my first note from Condor in 2009, and then started buying little pools of them myself. I could no longer represent them. I started buying so much. I went to work 10 years at Spurs Capital, in charge of deploying a couple $100 million on behalf of some institutional investors in the non-performing residential mortgage space. And so that's really what that's where I've spent the last 10,000 hours is buying mortgages, and working with teams of friends like Sam Hintosh, who are my boots on the ground in various places around the country, managing these investments. And I really see an opportunity in the near future on the horizon. And we all expect something to happen residential, but there's obviously a misbalance of supply and demand that can create a runway of this kind of, even if not upward prices in residential. I don't think we're going to see a bottom dropout like we did in 2008, but certainly commercial real estate is at a precipice right now. And while it is a smaller market on the mortgage world, not necessarily in the overall real estate world, but in the mortgage world, commercial is a smaller market comparative to residential. There is a surprisingly significant large percentage of commercial debt out there that isn't just Goldman Sachs loans to, institutional REITs. There are a lot of mom and pop investors, and I say that tongue in cheek, but less sophisticated everyday folks who graduated from 1 to 4 family investments to maybe owning a local retail center or a strip center or a 20-unit low-rise building. And a lot of those folks got stuck or are right now stuck inside of a huge shift in not only their cost of capital on a go-forward basis indefinitely, but then the resulting value change that has yet to be realized in commercial real estate. I think if you talk to the sophisticated commercial real estate investor or sponsor, they'll tell you commercial real estate's down, 40% in some markets already. It just, obviously no one's talking, it's not out there in the market. It's, people haven't repriced the actual repricing in many cases. You hear spatterings, right? You hear Brookfield asset managers come around and hand back the keys to 4 or 5 office buildings in downtown LA. And we're seeing that in downtown metros a lot. But this is going to be a contagion, I believe, that will spread into what I call the low balance commercial world. And that's anything under $10 million, really under $5 million in many districts. And I think there's an opportunity on the near horizon there that we should all be looking for. Darren, what do you think?
I agree. We that's one of the things last month, Bill, that everybody kept bringing up, and Barry brought that up earlier, was the fact that we continue to hear about how upside down and how delinquent the commercial side is, and what's going to transpire the next, because we've been hearing about this for a year, 2 years. It's been a while that the percentage of delinquent commercial properties, and we all drive by properties all the time. I don't know about you, but even around here where I'm in Pittsburgh, and you just see these see-through buildings, meaning there's nobody in it. And you have multiple floors that are empty. Well, no one's making any money if no one's paying any rent. Of course, then everybody gets upside down. What's happening in that space, and is that going to, cause a rippling effect, I guess, on the residential side? But we keep waiting for, something going to actually occur, and we're not really seeing that. I guess I'd want to expand that, because these guys are more interested on the residential side. I know we talk about how the credit card debt is at its highest amount, I think, of all time currently. Repossessions on cars is at an all-time high, at least it was. So there's a lot of factors. It seems like it's kind of baking into the cake right now as towards the REO space. With your, you got your head to the ground on the tapes and in that space. Are you seeing more activity? We keep talking about a little bit of a bubbling effect before the boil. Are you starting to see, what are you seeing, I guess, on that space? Because our conversations, I talked about this last month, but every time we talk to Fannie Mae, I just want to bang my head off the wall, because they're never in a hurry. They're like, it's a perfect job. I wish I'd come back in another life. I can have a job that doesn't matter what I do, and I'm still going to always have something to do or get paid. Because they continue to say it's going to be now 2026. So it's like, you said that in 2022 was 2023, right? So it just continues to just kick the can down the road. Yeah. I guess, but what's your, I guess, thoughts on the residential side on what are you seeing?
So such a good question. And, I say that one of the things that I've been saying now for the last few years is that the big unknown, the big wild card that we haven't been able to predict for, and still cannot predict for, is government intervention in our business. And I'm not a political guy, so I'm not saying that in any way politically. I mean the fact that, the government has done a really good job, which in many cases has saved a lot of people. But they've created a lot of programs around delaying the enforcement of debt collection, not just in our business, but in all businesses. And it's most heavy-handed, obviously, in the residential real estate space. And why not? They had the levers to pull. And they woke up one day and there wasn't so much consternation over the idea that you could just call up your servicer and say, I've got a cold and I can't pay my mortgage. And that worked for a few years. And it's still, I think the thing that scares me is that it's still kind of an unknown secret that still works today. If a large enough mass of Fannie Mae, Freddie Mac borrowers, which is what, 70, when you include Ginny, it's 70% of the mortgage industry. If everybody realized that all you had to do was call your servicer and say you have COVID, and you could renegotiate your mortgage on the spot today still, that might actually could have some effect on things if markets turn. I think the bigger problem we have right now is that we're still living in bubble land in all asset classes. It's not just real estate. And Barry, I don't know what your thoughts on this are, but I would love to think that there might be an asset class outside of real estate in which the bubble bursts before real estate and residential. I mean, we all know commercial is facing some issues, but maybe there's another. I mean, look at the stock market. Look at all the companies that are billion-dollar valuations that have never earned a profit, and they're not all going to be Amazon. Most of them won't. We've lived through bubbles before in different markets. Hey, Barry, what do you have to? You wanted to come off mute and say something?
Oh no, it's absolutely correct. Some of this doesn't even make sense. You look at Bitcoin, approaching $100,000 right now. The stock market just keeps going and going. After the election, it took a big bump forward, and it just seems to keep on running. So it is very interesting that, back to Darren's comment, you have all of these tremendously good things happening, yet credit card debt is through the roof, right? The car repossessions, the car defaults, the attorneys in our network that do that kind of work, the replevins, they're very busy. So there's a disconnect somewhere. And I just, does that mean an implosion of the residential real estate market? I honestly thought it would have started to happen. And it has. We've seen some softening. I know here in Vegas, the days on market and the number of showings is really down. I've heard the same thing for the Phoenix market. So I'm sure, that's kind of, and those were hot markets.
Yeah.
I mean, those were on fire markets. So, eventually that's got to catch up in the pricing. But
absolutely. I'm seeing it too. You know me, I'm looking every day at Vegas right now. And I was feeling in such a need to be in a rush 6 months ago to get something. Oh, sorry. I didn't mean to spotlight you. I was felt in such a rush to to get something. And now I'm seeing price drops all every week on stuff that I thought was going to go very quickly a few months ago. So we are starting to see, you're starting to see some of those. That I think what you're pointing to is, and I agree. I think that the resident, if we're sitting here relying on an influx of residential REOs in the near term, I think that that's a false expectation in a good way, because in many ways this, that means there's a runway for those of us that either are invested in residential now or in the business to kind of manage and advise people as we start to see the turn. And maybe for those of us that are a little bit more experienced to get out when we start to, those of us that are, those that are still holding on to investments, maybe get them out, but the other side of it is I think it's what you're pointing to is we need to go from a market that is driven on feelings back to a world built on fundamentals. And I think the Fed had that intention when they raised interest rates 2 years ago and started that process. And it hasn't yet, and no one's kind of predicted how long it would take, for all that free cash to run its way through the system, for people to finally have to wake up and pay the bills. You now, if you go back to the feelings things, I'll use my feelings. My feelings are that cash is drying up. We're seeing it in the numbers, and that there's an overall expectation of something that is going to change the overall paradigm of the market. I will always caveat that I am a little bit of a hater for Bitcoin, only because I only made money from like 400 to 4,000. And I was like, thought that I was so special, and now I'm the idiot, of course. So there's a little bit of anger and regret about that is the context for this. But I will say that I still feel the same way that I feel today. I think it's a brilliant thing. Of all the crypto, Bitcoin will be the bare aspirin, right? So if you're going to stay in crypto, that's the one to go with. At the end of the day, if we had a world war, if you had to go, if you needed that money to go buy food or pay for your kids' education, it's still not so readily available and usable. And if some kind of crisis comes along, I still to this day still think it's a lot of the value is in the feeling about it, as opposed to the fundamentals of it. Someday, it being worth 100,000 or even $1 million a coin might make sense, because there is a limited quantity, and if the overall markets are worth more in 50 years, yeah. But it's another example comparative to anything. Let's look at Zillow Corporation. Why don't we talk about Zillow Corporation? We all that's something in our backyard, right? Who Zillow is worth? It's worth something like six. I was looking this up. Gosh, I gotta get it. It's worth way more than all of the largest real estate brokerages combined. I'm talking the companies like, the confederations of the old Century 21s, which is Realogy. I'm talking about the Remax brokerage, which these are companies that have historically turned over millions and millions and millions and billions of dollars of real estate on a consistent level for decades now, that combined do not even add up to the market revenue value of Zillow, which it hasn't yet grabbed all the market share that it claims that it will someday have. And a lot of that is like exuberant ridiculousness. Barry, your thoughts on that?
I agree. I mean, certainly the valuation. I mean, that like Zillow is a 4-letter word in our industry, right?
Right.
Zillow says, right? One of the things you don't want to hear, and yet everybody says it. But yeah, that's definitely an interesting dynamic, right? I mean, so somebody that's so disrespected in our industry is such a monster influence in it. It's kind of a
but those chickens will have to come home to roost at some point. I'm starting to see it in some of the folks online that do this, where they that are investors that are saying, how does that make any sense? They're great. They have technology, they've got an audience, but when you just look at it, these other companies that have people behind them and careers and years of business loyalty that are consistently doing transactions comparative. And why does Zillow get to be valued at a multiple so much more extraordinarily higher than good old fashioned real estate brokerages that will still continue to do transactions? And it just doesn't make sense. And it's like that in a lot of asset classes across the board. And and unfortunately, a lot of us own stocks too. So there's a fundamental conflict of interest with this whole conversation, because we are now, it's the sign of the end of market. I could be saying this for another 4 years. It might not, this bubble may not burst for another 4 years. There's the government will still play a role. You know, if the Trump administration is successful in influencing the Fed to lower interest rates more, which we've now seen Jerome Powell pull back on because of, like what you said, Barry, this, you know, the irrational exuberance in the stock market post-election, you know, again, based on feelings more than fundamentals. At some point, the markets have to correct. We want that to happen. That'll strengthen the dollar long term, and it'll bring the affordability factor back into reality. For now, I don't know what residential portends. What I do know is that there's a lot of distress in commercial. So I'm doing both. I'm still staying in resi. There's still enough. I mean, it's still, even if it's a 1 or 2% market, there's still enough, obviously, for us to, you know, it's a big market, right? So,
well, and think about where it's been, right, Bill? I mean, it's been pretty much zero. It's been dead. So
that's true.
I keep going, just go back to a norm, you know, as towards your point, as toward the government intervention, and allowing people to stay in properties. And and I don't know where the Trump administration is going to fall on this, but I would think it's definitely looking like there's going to be a revert back to maybe language and agreements that say you pay, you stay, you don't, you won't, which we've kind of gotten away from for a while. COVID definitely was a huge factor to that conversation, which of course made a lot of sense. I just don't know where that's gonna go from now, but we will see. I mean, right now, again, we've been at zero. So if it gets to 1% or 2%, I think we'd all be like, okay. The SFR
yeah, I mean, that's the biggest problem for our industry on the residential side, is such a large portion of it. You going back to Fannie Freddie, this is how this whole thing started, was the government, right? Going back to Fannie Freddie, you know, they're probably the biggest potential source of files for you guys and all of the folks on this call in one fell swoop. That is, they're not in any hurry. Maybe that was politically driven. Maybe it was just, you know, that's just the way they operate. It's a big government. If they don't, at some point, what do you think? Do you, Barry, Darren? I mean, you talk to them more than I do. When do they start enforcement on a more, on a more grand scale? Because there's so many redefaults of redefaults going on, and then they're just remodifying those redefaults of redefaults. At some point, they've got to be like, okay here, you know, like let's like we gotta work this stuff out the system. Any thoughts?
Yeah, Darren mentioned it earlier. I mean, we've had numerous conversations with those guys, sitting down face to face and talking about, you know, a lot of it we focused on the eviction side of it, right? Helping them there, but it goes hand in hand with the REO. But it's always, you know, as Darren mentioned previously, it's always next year, second quarter next year, third quarter next year. And that's been what people have been saying for years now. And the hammer just never falls. And again, it goes back to my lack of understanding of, I don't understand what's holding this thing up so well right now with these prices. I mean, you know, as you said, it is starting to soften, but you know, when is that gonna start leading to defaults?
I mean, it's not, I think, again, I think when we see, maybe it'll happen naturally, because if there is this, the problem that I see here is that there really is what's going to come into clear vision when markets turn. And I'm not talking real estate market, I'm talking general market cycle, like we go into a next recession or depression or whatever it might be. I think there will really be an eye-opening as to the disappearance of the middle class in this country, and the difference between completely over leveraged folks that are now dropping into lower income, net worth levels compared to the few that have a lot. And those few that have a lot obviously it's still millions of people in America, right? Have second homes, third homes, fourth homes, Airbnbs, investments in cryptos, investments in this. And one asset class going bust will hopefully spark some people to wake up and start selling, and we've seen it before. I mean, in 2000, when you think about the size of the real estate market, 2006 was still a really hot real estate market. When I look at transactions that went on, there was still a lot of stuff.
Even in 2007. Yeah. I mean, I was in Virginia at the time and we were getting 20, 30 offers. We had there's escalation clauses. It was a crazy market.
Right.
Hey, and Bill and Larry, you have to jump in and help us out, I guess, because Barry and I both have to jump. We have that 1:30 that we can't miss. So, but Bill, we appreciate you coming on. We appreciate everybody else that joined us, and then you guys can run with it. But Bill, can't thank you enough. Your expertise, and by the way, he has a podcast. You should talk a little bit about. You guys should follow him and watch his podcast. It's excellent. Barry actually was a guest on one of them too, so it's definitely dig it up.
Are we drunk for that or what?
Yeah, we could try to get the count up on that, the views. But hey, thanks y'all. I gotta run.
Okay, go get us some clients. Come on, go nail some clients for us.
Get some business.
All these folks are relying on you, Darren. Come on.
I know it's a lot of pressure, but we're gonna do it.
Okay.
Thanks, guys.
Probably the easiest way for anyone to either get in touch with me or follow the web, follow the podcast. I'll just drop my link tree in the chat for everyone. And but I'm certainly welcome to hear other opinions in the room, especially if anyone has some local insight into various states or local markets where they're seeing any cracks in the concrete, so to speak, either on the residential or commercial side. But I think it's going to take some, Eric, I would love to hear your opinion. I think it's going to take some asset class going. Maybe a private equity firm goes down. Maybe a big bank has, announces it, and then all of a sudden you go from, wow, things are still selling, prices are still going up, and boom, the market's done. All of a sudden, nobody's buying, and we saw it from 2007 to 2008. We've seen it. It's happened. I just read this book, which I would recommend everyone read, called "Bubble in the Sun," and it's about the 1920s Florida real estate bubble. There was a boom that happened in the 20s when Henry Flagler built the railroad, and then several other developers created these towns both in Tampa and in Miami along the eastern seaboard. And there was a 2-year period from 1924 to 1926 where everybody of the upper class was pulling money out of their new Northeast banks to the tunes of millions, billions by today's standards, getting on trains, coming down to Florida and speculating on swampland. And the whole thing busted so dramatically by 1927. Things that had gone up 10x were back down to nothing. You couldn't sell. And there's a case being made in this book, Bubble in the Sun, for that speculative exuberance and that Florida real estate market really being the cause of what led to the 1929 stock market crash, as people were then all of a sudden just trying to pull cash together all of a sudden a few years later. So very interesting times that we're in. Eric, what do you think?
Yeah, well, I think there's a couple of things that we have to look at, and Darren, Barry, Bill all kind of mentioned this, right? We've been in explosive growth for 15 years now, guys. We have our bond yield inverse that has predicted every recession, right? Where short-term money is paying more than long-term money. That is inverted at this point. Darren talked about consumer debt, which is at an all-time record high, along with auto loans, right? I've been telling people, in these next 4 years is the time to buy your dream car, because you're already seeing There's some dealerships that have over a 17-month supply of inventory. What happens to the housing market when we have 17-month supply of inventory, right? Prices are going down. It's a buyer's market. You can negotiate.
Oh yeah. I got a story
right?
about that, by the way.
Tell
My
us.
son is buying a Ford F-150 Lightning. These things have been like, first of all, Ford dropped the MSRP from 23 to 24 from like 93,000 to 81,000. So my sister-in-law, who bought one of the first ones out, which is the electric F-150, a couple of years ago, she paid 120,000 for the truck. And my son has gotten with incentives and everything. He's negotiated. They actually are they still have 23s on the lot here in Vegas that they can't sell because the 24s are less expensive than the 23s. So we're getting a 24 for about in the 60s now on discounts. So
similar like Hertz started this program where they bought a bunch of Teslas, right? And Hertz, they only use their cars for a couple of years. They have an abundance of resale Teslas right now, where a couple of years ago, it was a pretty good deal. You could pick them up in the low 20s. Right now, you can pick some up in the $16,000, $17,000 range for a Tesla. It might be the Model 3 or something like that, but literally like less than 50 to 100,000 miles on it, right? Like these are the opportunities and where we need to learn from the past so that we can set ourselves up, right? Like let's capitalize on this and really take advantage of that, because when this market tips, corrects, does whatever we think it's going to do, that's the time that we build wealth, guys, right? That's the time that you guys.
You mentioned the yield curve, and I just Googled, of course. The yield curve has been inverted since July of 2022, the longest and deepest inversion in US history. Last longest one was in 1978, 624 days. We're already on our 793rd day of yield curve inversion. And I guess what knocks us out of that, Eric? It's either a major crash or the which would obviously cause the Fed to have to lower interest rates, but it wouldn't happen on its own. What happens? How does that all happen?
Yeah, so think about this, right? And this is very visual. If you guys I have the American Express app on my phone. You guys can go open up a CD with American Express right now within 3 minutes. Right? And you can choose your notes of CDs, right? If you choose a 1-year note, last time I looked, it was paying like 4.3% a year, 4.5% a year, or something like that for a 1-year note. If you have money in a savings account, there are much more lucrative ways that you could be holding your money right now. But two, if you choose a 5-year note, it's paying 1.25%, 1.5%. Guys, think about this logically. It doesn't make logical sense for a bank to incentivize you to invest shorter term. Why they are doing this and why this bond yield inverse has predicted every recession is that banks don't know what the hell is going to happen in the near future. So they can't be locked into 3 or 4% because that would be devastating to them. So they'd rather pay you more on a shorter note and be able to adjust as this market comes along. One of the other things that I just want to highlight that I think Bill had talked about is this government interference that we've had. Well, here's the thing. Since 2020, when COVID came out, we have had more forbearance agreements, loan repayment, modifications, etc., than we ever have as well. And so we keep extending this, which is why our foreclosure rates haven't ticked back up to a normal cycle. And at some point, either the government has to subsidize these banks, or people have to be paying, or we have to give the banks the ability to take these loans back. And something has to give. Otherwise, you're going to start seeing these banks start to go down. And when these banks start to go down, that's when you start to see shit hit the fan, and you're going to have this snowball type effect.
Right.
Of things go from okay, the market's okay, to oh god, like we're in trouble at this point in time. All of us, look, we're positioned for that at this point in time with our relationships and stuff. But those are some things I want you guys to think about and highlight.
I think that that you bring up a good point about the banks. There is a very delicate balancing act going on right now between banks and their regulators and the Fed, obviously. The Treasury, obviously the cost of capital to the public, the cost of capital to banks, all of that plays a role in the survival of banks. And also, like you said, the bank's abilities to enforce, enforcement action. And right now banks, that's the reason, by the way, I think banks got out of residential mortgages pretty much in terms of like the long-term servicing and ownership of residential mortgages post GFC. It's a market that they kind of just outsourced, to all of us. And I think because there's not as much PR risk, obviously, when you have to enforce a commercial debt. So what's going on that is a pseudo version of the residential interference is not interference, but it is the Fed, the banking system has created, FDIC has created a new ways to classify subperforming, non-performing commercial debt that sits on the bank's balance sheets. And so it's part of that delicate dance that everyone's doing, which is the Feds have given the banks basically a tool, and we're going to call this TDR, well, because that's the name of it. Okay. If you want to look into TDR, trouble debt, I don't know what it stands for, trouble debt relief or something like that. But it is a tool that allows any bank to completely rewrite, based upon whatever underwriting guidelines they determine, the terms of any mortgage note, secured note that the bank has in their balance sheets. And so that means, in other words, if you are in you've got a $50 million loan on a downtown Chicago office building, and you're I don't know why I always pick on the town that I was born in, but whatever. It says so many things in people's minds. So, and all of a sudden your occupancy has gone from 90% to 30%. So on that $50 million loan that used to cash flow at a 1.12 DSR DSCR is obviously underwater at this point. I'm going to make up rough numbers. You're supposed to be paying $500,000 a month in mortgage payment, and that was getting covered by $600,000 a month in rent. That is now $200,000 a month. I can go as the sponsor of that and the borrower on that $50,000 loan and go beg the bank for a TDR consideration. And if the bank says, okay, they could rewrite the terms of that loan, which basically they could create A and B notes where the B note is zero interest and it sits in second position. It doesn't even, blah, blah, blah. That's a very common thing. We're going to start to hear a lot more about that in the coming years. They could drop the interest rate down to zero and just take a partial payment of $200,000 a month, whatever it is that the sponsor could afford. But because the bank as long as the sponsor makes a payment, if it was $1, if they went from a $500,000 a month to a new term where you're paying $1 a month, the bank has the right to keep that loan on their books as an accruing loan. So it doesn't get classified as bad debt. Dang. And that's going on in big all over. Now, so the banks have all the choice. They get to choose who's the good borrowers, who's the bad borrowers, who are we going to help out, who not. but the feds gave them the tools to do that. And they're basically doing these, closed door modifications or forbearances, however you want to call it, for their best borrowers, whoever they want to help out. And then they have the right to enforce the ones they don't. But you're seeing, and the banks also have to do it. Because if they all of a sudden just threw into foreclosure every loan that's having trouble right now, we would see a major crisis on
Absolutely.
it. It would freak out the American public.
So, Bill, let me ask you this. Where do you see, from an agent perspective, right, from a realtor perspective, whether it be commercial, residential, where do you see the biggest opportunities that agents should be setting up and getting ahead of that curve?
Small banks and credit unions. We're the only country in the world with 4,000 banks and credit unions. If you had one client in your local town there's many that are very regional. It almost fits well with the concept of brokerage being local in nature, right? That they need most smart bankers don't go outside their lane. So if they've got loans on their books, it's going to be to the customers in their local community who are usually buying real estate in that community. They need a local expertise to deal with what is going to happen or what may be going on in terms of value changes in that market. And I'm not saying there's a plethora. So if you're looking for a get rich quick scheme, where it's like, I'm going to be the next Marcus and Millichap and go on a nationwide basis, that's not this. But if you want to start to build a base, I think there's local bankers I know there are local bankers and credit union officers all across America right now that are like deer with their headlights on. With the deer, with the headlights in their face, that kind of thing. I've seen them this year.
Yeah. And to add on to that, guys, like a lot of you guys I talk to on a regular basis, private money, right? Like,
oh, absolutely.
See, right? Like these private equity lenders and stuff like that. These private capital firms that are doing fix and flip, new home construction, short-term rentals, guys. Like, as this market corrects, we've talked about this, I think the Airbnb space is going to get crushed. Most of those Airbnbs are not profitable today because they bought in 2000, like prime example, I have 20 acres in Fredericksburg, Texas, right? In 2021, we were getting $700 to $800 a night during peak season. Now we're getting $350 to $400 a night. Now, thankfully, like, we're still net positive, right? Like, it pays our mortgage note. We're in a good, flexible position because of equity, because of everything that we have.
But what about the guys that bought it on the $700 a night valuation? They're upside down, right?
Yeah, and then now it's not making that, right? And these are things that you need to look at. Like, again, these next 4 years, how do you set yourself up for success? Could you buy that property, right, at a $200 to $300 a night evaluation? And over these next 6, 7 years, that market starts going up. Now you have this equity, you have this appreciation, and you have less competition in this Airbnb space. And you have a resort vacation rental, right, that you can go to anytime. Like, this is where I want you guys thinking at the end of the day.
Yeah. And I think that you will find we're so used to having bankers slam the door on our face for 15 years that we're kind of given up on that world. There was a time that I used to hear about because I was an REO broker for those few thousands, the early thousands, like from 05 to 08. Well, I was still doing the commercial stuff, but I also had this little REO group, even though I didn't have any idea what REO was going to be. And I just had some mentor that said, go do it. There's a storm coming. Stop buying residential. Do it, And, the reason reason I say this is that after that period of time, banks basically outsourced everything. So it became very difficult and a waste of time. And certainly you're not going to call Bank of America and get anywhere with them. They did everything through Equator or whatever it was. But before that time, REO was a handshake business. It was an asset manager calling, the REO broker with a relationship with the asset manager. They'd meet at the REO Mac conventions, or, they'd meet a couple times a year, and you would be a specialized, and every banker that had a nationwide portfolio would have brokers that specialized in their area. And there was a real value to it. And I watched the industry kind of get hoodwinked. I say this with Barry and the other third-party guys not here anymore because they weren't part of the problem, but get hoodwinked into the ResNet Equator. It's going to make things more efficient. It's going to give you more control. And it helped certain people, but we realized that it didn't help a lot of the real REO brokers, especially the real professionals that know their craft and whose advice now all of a sudden got so devalued. And I think that there's a general awareness in banking and even in private equity amongst guys, because I've been screaming this at the rafters for years, the value of having a one or two real professional brokers in each market, and not just spreading the business out to grade people on numbers and who can do fastest and and blah blah blah, and then cut their fees in half as a result of it. So there's a real hopeful shift going on there, and I would give some credit to local banks and there are folks out there that need help, and the right professional folks that have been around, like Sam, for through cycles, that have guys like you, that have guys and gals that have the experience, that can walk in and be that calm advisor to these folks. And it may only start with one or two properties. Oh yeah, it could start, because I've seen it happen. 2 years ago, there was no bank distress whatsoever. A year ago, banks were all of a sudden being willing to take par and leave us to the arrearages and escrows. Now they're starting to just do NPL sales to us at losses. And there's a real recognition that there's at least some portion of their portfolio, 5 to 10%, that is in a workout situation right now. So even if you're just there providing drive-by checks on the property, here's what I think it's worth, it's all for free. Now's the time. Give your time up for free. Get these clients in there. In the other third category, besides bankers, credit unions being one category, private equity investors, Eric mentioned, there's still a ton of that in the industry. Look at my balloons. And then the third thing to think of, to remember, is the word that never even existed when I got into this in 20 years ago, the family offices. Family offices are these, the rich families of this country, and there are millions of them now, that have pooled together. Sometimes multiple families come together, and they have either a family member or they hire an outside firm to do their investments. This has been a huge growing trend the last decade, and they are growing a larger and controlling a larger and larger amount of the capital that is out there. A lot of those folks are folks that bought into these loans, like what Eric's talking about, these fix and flip loans. These fix and flip originators don't all keep these loans. They fix them, they originate the loan, they take the points, and they try to scale them out and sell them off to Wall Street or family offices. So believe it or not, I'm getting calls from family offices that were clipping 12% coupons the last 5 years, doing, at fix and flip, just investing passively in hard money loans. What the industry has called it RTL, DSCR, whatever other BS name they've given. It's hard money loans, and they've woken up all of a sudden and realize, wow, these are HUD money loans. They might actually, some of them are actually going to go bad. So if you have any connections to family offices, go ahead, Eric.
I just helped assign 5, actually, like within this last year, from one particular company. There was 3 in San Jose, $3.5 to $4 million a piece. 5 in the Phoenix metro market, from 1.5 million up to 6 million. This isn't just starter homes, guys. Like, this is some really, like, because when the market was going up, like if you bought in 2020, 21, like you couldn't make a bad buy looking back in today's standards because of the appreciation. People are still buying on that. And the market is not going like this anymore, right? It's like this. So they're buying on these old trends that made them a lot of money, and they haven't adjusted. And so now they're like, oh, damn, I don't know if these numbers pencil out. And they're halfway through these projects and stuff like that. So there are some big opportunities ahead of us here. And man, I see a lot of names here that I talk to pretty regularly, right? We will continue to position to be in front of those, right? With American Destiny, with a lot of our different partners, with Darren, with Barry, right? And this is where proximity to power, like, stay a part of these groups, right? Stay in front of this curve as we were in the last time, and it will set up what's going to happen, in my eyes, for the next 4 to 8 years at this point.
It's been really great to be with you, Eric, and Barry and Darren are obviously close friends of mine. And many of you are friends of mine. It's been great. It's great to see you. If you have any questions, you can find me on LinkedIn or on the web or email or whatever. I'm pretty good. I try to return every message.
Beautiful, guys. Well, I appreciate your time here with American Destiny this morning. If you guys need anything, make sure that you guys reach out. Until then, guys, go out there, and we'll be back next month. I'll talk to you, Larry and Bill.
Thank you.
Thank you, everyone.
Thanks.
Have a good one.